There's a quiet group of Australians who haven't worried about a pay cut in over 2 decades, not because they're lucky, not because they inherited anything, but because they own a slice of companies that have written them a check every single year without missing once. Some of those checks started small, a few $100s, maybe 1,000, but the companies kept paying and paying and paying. And today, some of those same people are living entirely off those payments. That is what consistency in the market actually looks like. And today, I'm going to show you exactly which ASX stocks have paid dividends for 20 years or more without stopping, and why that streak tells you something that a share price never can. Most investors look at a stock and ask one question: what's the price doing? That's the wrong question. The right question is, has this company kept paying its shareholders through every recession, every rate hike, every global crisis, and every bear market for the last 2 decades? Because if it has, that's not luck. That's a business model that works in all kinds of market conditions. Here's the shock value number that most people don't think about. The ASX 200 has crashed more than 40% twice in the last 25 years, once during the GFC in 2008 and 2009, once during the COVID collapse in 2020. Share prices got absolutely smashed, and yet a handful of Australian companies kept paying their shareholders through both crashes. Some even increased their dividend. That is the list you want to be on the right side of. Let's start with the most obvious one, and the one most people underestimate: Commonwealth Bank. CBA has paid a dividend every single year since it listed on the ASX in 1991. That's over 30 years of uninterrupted payments. In 2024, CBA paid a full-year dividend of $4.50 per share. If you'd bought 1,000 shares back in 2004 at around $28 each, that's a $28,000 investment. Those same shares today are worth over $130,000 in capital growth alone. But the dividend income on your original $28,000, you've collected well over $60,000 in cash payments. Your original investment has paid for itself twice just in dividends, and it's still paying. Now here's where it gets interesting. CBA isn't even the highest yielding bank on the ASX right now. Westpac, AMZ, and NAB are all sitting on grossed-up yields, that's including franking credits, of between 7% and 9% in 2026, and all three have maintained dividends for over 20 years, with only brief interruptions during the absolute worst of the GFC. If you're building a dividend portfolio and you have zero exposure to Australian banks, you're leaving one of the most reliable income streams in this market sitting on the table. But the banks aren't the full story. Let's talk about Wesfarmers. This is the company that owns Bunnings, Kmart, Officeworks, and a string of other businesses that Australians spend money at every single week, regardless of what the economy is doing. Wesfarmers has paid a dividend every year since 1984, 40 years straight, through the recession we had to have in the early 90s, through the dot-com crash, through the GFC, through COVID. The yield sits at around 3% on the surface, but with franking credits grossed up, you're looking closer to 4.3%, and that dividend has grown consistently over time, which is the part that matters most for long-term income investors. Here's the trap most people fall into. They look at a 3% yield and think, that's not enough. I need something paying 8 or 9%, so they go hunting for the high yielders. And this is where portfolios get destroyed. A stock paying 10% on the ASX is almost always telling you something. Either the price has collapsed because the market knows something you don't, or the dividend is about to be cut. Chasing yield without checking the streak is one of the most expensive mistakes a new investor makes. The streak is everything. A company that has paid dividends for 20 consecutive years has survived things you can't model on a spreadsheet. It survived changing governments, changing interest rates, changing consumer behavior, currency swings, and global pandemics. That track record is evidence of something real: pricing power, demand durability, and management that respects shareholders. Let's look at Telstra. Love it or hate it, Telstra has been writing checks to shareholders for decades. The dividend story isn't perfect. They did cut during the NBN transition period, but they rebuilt it, stabilized it, and today sit on a grossed-up yield of around 6.5 to 7%. For income investors who want telecom exposure, Telstra remains one of the most recognizable payers on the ASX. The key with Telstra is not expecting growth. You're buying it for the income, not the capital story. Then there's BHP, Australia's biggest miner and one of the most debated dividend stocks on the exchange. BHP operates on a progressive dividend policy, meaning they aim to maintain or grow the dividend each year. The reality, it's tied to commodity cycles, so it does move around. But over a 20-year window, BHP has delivered enormous dividend income, particularly during commodity booms. If you held BHP through the mining supercycle in the mid-2000s and the post-COVID commodity surge, the dividend payments alone would have made the position worthwhile several times over. It's not a set-and-forget income stock, but it belongs in a diversified dividend conversation. Now let's talk about the one most people have never heard of, and that's exactly why it's interesting. Washington H. Soul Pattinson, ticker WHS on the ASX. This is a 120-year-old Australian investment company that has increased its dividend every single year for over 23 consecutive years, not just maintained, increased, through the GFC, through COVID, through everything. It holds a diversified portfolio of Australian businesses and has a track record that very few companies anywhere in the world can match. It doesn't get talked about because it's not exciting. It doesn't move fast. It just keeps paying and quietly growing. That's the point. Here's the real takeaway. The companies on this list are not glamorous. None of them are going to 10x in a year. Nobody is posting about them on finance forums at midnight, but they share something that no hype stock can offer. Proof. Proof that when the world fell apart, they kept honoring their commitment to shareholders. That's what you're actually buying when you buy a long-term dividend payer. You're not buying a share price. You're buying a revenue stream with a history. And here's the compounding piece that changes everything. If you'd reinvested every dividend from a basket of these stocks over the last 20 years, CBA, Wesfarmers, Soul Patts, Telstra, the major banks, your portfolio wouldn't just have grown from the price appreciation, it would have multiplied because every dividend bought more shares, which paid more dividends, which bought even more shares. The reinvestment phase is where ordinary investors build extraordinary outcomes. And then, when the time is right, you flip the switch, you stop reinvesting, and those same dividends that were silently building your wealth start landing in your account as income every quarter, like clockwork. That is what 20 years of uninterrupted dividends can do, not in theory, in practice, on the ASX for ordinary Australians who simply stayed consistent. If you want to know exactly how to build a portfolio around these stocks, how much to allocate, how to structure it for tax efficiency using franking credits, and how to know when a dividend streak is worth trusting, that's exactly what the next video covers. Make sure you're subscribed and notifications are on so you don't miss it. I'll see you there.